looking here at Chapter 17 related questions, and now we're going to start looking at a few, just get a little glimpse of what it's like computing some of the amounts on your Schedule A. So when we're starting to look at least adding amounts to see if our itemized deductions are going to be greater than the standard deduction. So the first section of your Schedule A deals with medical expenses. So let's look at Dottie Sprague. Incurred the following medical expenses this year. Payments to physicians and dentists, $4,300. Payment for 2-day stay at Mercy Hospital, $6,250. Payments to physical therapists, $2,100. And prescription drugs of $1,010. Dottie's insurance company reimbursed her for $8,800 of these expenses. If Dottie's AGI is $26,550, compute her medical expense deduction. All right, so the one thing we're not going to really look at least here, because, well, I guess we looked at it. One thing you want to make sure, are these really medical expenses? Right, so make sure medically needed. Your client may bring you things such as maybe gym memberships, right? Health club fitness memberships. And you say, well, those not deductible. I'd say in most cases, no. Are they always not deductible? No, because I think you could make a case that it's part of maybe a physical therapy routine, and you have, doctors ordered you to do that. That's when, it's part of it. You could make an argument that it's medically needed, but me just wanting to be a member of the gym or the health club, whatever that is, usually not. Same thing with like cosmetic surgery, right? So cosmetic surgery, if it's something to fix a medical issue, then that would be something that would be, but if it's just me wanting to look better, then that's usually not going to be deductible. So that's really in practice what you'll look at that we don't see here. But even starting that, so that's one of the areas that is everything really medically needed. Right, the other thing you want to make sure of is it really all out of pocket? So, don't include anything that's not out of pocket. And what do I mean by that? It means that you've not been reimbursed for it. And this one does come into play, right? The insurance company reimbursed her for $8,800 of these expenses. And that's something, it's much better overall, maybe not on your tax return, but overall, if you get a dollar for dollar reimbursement, right? So getting $8,800 of reimbursement is a good thing. It's not bad. You just need to make sure though on your tax return that you don't try to claim it twice. You don't try to get a deduction when you've already been reimbursed for it. So that's one of the things that we need to make sure that we have make an adjustment for. So let's pull up our calculator here. 4,300 plus 6,250 plus 2,100 plus 1,010. So we have $13,660 up here. So first thing we need to make an adjustment for, right, that $13,660, we've got reimbursed by $8,800. Right, so we need to reduce that by $8,800. So that means $4,860 is out-of-pocket expenses. Right, so you notice here, this is one of the choices we have here, right? But that's not the answer, because, and it might be good to look at your Schedule A because you can kind of see the line where it looks at an adjustment. But the way the medical expenses work, it needs to be out of pocket, and whatever you have needs to be greater than 7.5% of your AGI. That's one of the reasons adjusted gross income number was important. If you look a couple of years previous, you're going to see some where if you're in a certain age range, it needed to be over 10% of your AGI, and then if you had met a certain age, you would get the 7.5. But right now, they've gone back to what it used to be and say you just need to limit your AGI to 7.5%, and anything over that 7.5% limit, you're going to be able to take. All right, so next thing we need to do then is figure our AGI limit. So I said AGI is going to be $26,550. We said it was going to be 7.5% of that. So 26,550 multiplied by 7.5%, That's going to be $1,991.25. Right, so anything above that is what we can take. So we take our 4,860, we subtract off 1,991.25, and that's going to be the amount we get that we're really that's counting toward our deduction total. So I'm just going to do that backwards here. So it's 2868.75. Right? So that's going to be B, $2,869. That would give us good practice looking through, add up anything medically needed, but also make sure you use this AGI limit. Right? It's not on every category of your itemized deductions, but it is on that one. Okay, so let's keep going down here. This is one I'm going to let you try for yourself. So Mr. and Mrs. Olivia, ages 70 and 67, incurred the following unreimbursed medical expenses this year. Right, so it tells it what those are, and it says if the Olivia's AGI is $43,150, compute their medical expense deduction. So I'm going to let you hit pause here for a minute, and then I'm going to come back and let you know at least what I came up with. Okay, so when you work through all of this, you actually come up with $5,124 is going to be the amount of medical going toward the itemized deduction total. Number 8 says Spencer paid the following taxes this year, right? So this is the next section of your Schedule A. It's going to be taxes paid. So they paid federal income tax of $12,034, federal employee payroll taxes of $4,590, state and local income tax of $5,724, state and local sales taxes of $2,998, and local property tax on personal residence of $3,300. And it wants us to compute Spencer's itemized deductions for taxes. So for this section of that Schedule A, that's really what it's wanting us to look at. Right. So one, and clients will give you lists like this, right? You don't get any adjustment on your Schedule A for how much federal income tax you paid. That's really just getting your account to what it should have been to begin with. So they're not going to give you any benefit for waiting till after you file your taxes to pay. Right, they're also not going to do anything about your payroll taxes. And again, one of the keys, we're talking about federal payroll tax, but even on the state payroll tax, well, I guess the income tax part of your W-2 is going toward your withholding. Right, but that's a withholding, that's not a tax. But the first two don't go to anything. But then what it works is you get the greater of either the state and local income tax or the state and local sales tax paid. If you are working, and especially if both individuals are working, more than likely it's going to be the income tax. But another option you have is to keep track of all the state and local sales taxes you've paid throughout the year. And if that's greater, you can use that. Right. The time I've seen it help somebody, I had two of my clients had retired, and so they didn't have their W-2 income that year. It was the year before they retired, and they bought this huge RV and were going to travel around the country for retirement. So that year, the sales tax they paid on that RV was notable, right? And lucky for them, it was even before the limitation we're going to look at the very end here, right? But first thing is you get the greater of these. You don't get both. You don't add these together. You get the greater of them, right? So $5,725 is what you're going to take because that's the larger of the two. Then you do get credit for your local property tax. So even if you had vehicle, they don't mention the vehicle, but if you had paid local property tax on your vehicle, then you could also add that. But all we know about is our personal residence. And I remember from practice, it wasn't unusual. If I already knew they were going to use their itemized deduction, it wasn't unusual for me to reach out and ask them, did you pay any vehicle tax? All right, so we know the 3,300 here. So you're going to add those two together. And I don't think we're going to hit the last limit, but we're going to talk through because it's important to know. So we add those two together and we get $9,025. Right, so before about 2018, you didn't have to do this last part. But, and this is one of the changes, everybody says everything got better, but it didn't. Now, after 2018, started 2018, this whole section is limited to a potential $10,000 total. Right, so technically what we're saying is that we had 9,025, it's less than 10,000, so we only get credit for what they paid. So our answer to this would be 9,025. Well, what if we did this math and it was 18,000? Right, that's over the $10,000 limit, so we'd only be able to take the $10,000 limit. That's what he's wanting to make sure we understand. Okay, number 9 takes us down a little bit farther on Schedule A to your charitable deductions, and I like this one because I don't know, it kind of what tugs at our heart may not always be good for tax purposes. Doesn't mean we shouldn't do it. So it says, which of the following donations does not qualify as a charitable deduction or charitable contribution for federal tax purposes? So A says $50 cash given to a homeless panhandler. B says used furniture valued at $300 given to the Salvation Army. C says $3,000 cash given to the University of Georgia. And D says $600 cash given to the Boy Scouts of America. Right, so one thing you want to make sure, is it a 501c3 organization? Right, so it's testing on a couple of things. This isn't like a non-cash donation. These are cash donations. That doesn't make a difference. You can do non-cash or you can do cash donations. That's fine. The key is you want to make sure it's going to be 501c3. And this is. If it's one I had not heard about before, I would look it up. Especially make sure you're not, if it's directly to a political action committee, right? No. People are getting creative now, so they may not donate to the PAC, but they may donate to this 501c3 who swears that part of their mission, maybe to protect certain things, and they think a vital part of that is to make sure this individual is in office because they also support those things. So that's starting to get abused, I think, a little bit. But as long as you're giving directly to the 501c3, that should keep you out of the argument. However, A here, although it's a nice thing to do, if you give cash directly to a homeless panhandler, that's not going to be deductible. That's not going to add up to your itemized deductions. So am I saying don't do it? I would say be safe about doing anything like that, right? Because you can get yourself in danger. But as long as you can stay safe, I'm not saying don't do it. Just don't try to claim it as a federal tax deduction.